Committee will come to order. Mr. Roy.
Chairman Lankford and Jordan and members of the Oversight Committee, thanks for inviting me to speak with you today about the Affordable Care Act's co-op program. As others have described, co-ops were introduced as a substitute for the so-called public option by Senator Kent Conrad. The idea was that co-op plans, shorn of the profit motive, would offer lower premiums than traditional insurers. However, I regret to report that there are fundamental flaws in the way the co-op program was designed, making it unlikely that co-ops will ever achieve this goal. Failure of the co-op program could cost taxpayers as much as $2 billion. In addition, failure could expose hundreds of thousands of co-op enrollees to unpaid medical bills. The argument that co-ops will succeed because they're nonprofit ignores the fact that nonprofit insurers are already widespread in the United States. In Senator Conrad's home state of North Dakota, Wellmark Blue Cross and Blue Shield, a nonprofit, controls 90% of the market. Massachusetts has the costliest health insurance market in the country, despite the fact that the state's 4 largest health insurers are nonprofit. If the fact that co-ops are nonprofit is not a genuine market advantage, what advantages do co-ops have? Under the ACA, co-ops cannot, at least in theory, be run by existing health insurance companies. As a result, co-ops will have to negotiate from scratch reimbursement contracts for every type of medical service with every hospital and doctor in their network. This is an extremely difficult and labor-intensive process. The likelihood that co-ops secure lower rates than established insurers is extremely low because, as startups, co-ops lack the patient volume necessary to establish bargaining power with providers. In addition, co-ops will lack the large databases and management experience that established insurers use to identify opportunities for higher quality, cost-efficient utilization of medical services. Nonetheless, HHS claims that co-ops will be more efficient than existing insurers because, quote, new entities are not saddled with existing administrative and information systems, which are often outdated and cumbersome to coordinate and upgrade, unquote. A Silicon Valley venture firm would laugh this argument out of the room. Even large, well-capitalized insurance companies rarely stray outside their established markets because entering new states and regions is extremely difficult. If all it took to succeed were new computers, they would have done it by now. Insurers are required to keep a certain amount of assets in reserve in case their spending on medical claims exceeds the amount they've received in premiums. However, federal loans to co-ops are not assets, but liabilities, because they have to be repaid. As a result, HHS engaged in a kind of accounting legerdemain so that its co-op loans would count as assets. This means that HHS is helping co-ops overstate their true financial health. Even so, HHS estimated in 2011 that the co-op loan default rate would be 40%. The Office of Management and Budget projected an even higher default rate of 43%. And the government has no effective way to recover funds from co-ops that default on their debt. According to one estimate, at least 11 of the co-ops were licensed in such a way that if they go bankrupt, they may not be able to pay outstanding medical claims before first relieving creditors. This means that Americans who enrolled in co-op-based insurance in good faith and paid their premiums on time may not find that coverage is there for them when they actually need it. This problem could further damage consumer confidence in the broader exchange-based insurance marketplace. It should be noted that skepticism about the viability of co-ops is not limited to critics of the Affordable Care Act. Indeed, according to Jerry Markin of the Washington Post, quote, White House officials repeatedly suggested that funding for the co-ops be reduced. Some senior White House officials considered the co-ops risky, including for prospective policyholders, and questioned whether the loans would be repaid. My recommendation to this committee would be to aggressively review the existing co-op loan recipients and at the very least suspend the disbursement of loans to those co-ops with a below-average likelihood of future solvency. Stewards of taxpayer dollars should not throw good money after bad and place vulnerable Americans at risk. The 2014 open enrollment period ends on March 31, giving co-op enrollees time to switch to a more financially stable insurer. With anything as complex as health reform, sweeping changes enacted by Congress are bound to have unanticipated consequences. In the case of co-ops, future insolvency is not unanticipated, but assumed by experts in both parties. This should be an easy decision for both skeptics and supporters of the Affordable Care Act. I look forward to your questions and of being of further assistance to this committee. Thank you.
Thank you, Mr. Roy. I recognize Mr. DeSantis for a line of questioning. Well, thank you, Mr. Chairman, and to both the chairman. Thank you for having this hearing. I think it's very important to be. I mean, it's such a huge law. There's so much money thrown around. We're the only line of defense for the American taxpayer to keep track of this. It's interesting. There was this report by the Congressional Budget Office. I just wanted to point out, Mr. Roy, maybe you can speak to this. I know you've written about the report. But this notion of it essentially creating a disincentive to work and that it's going to create less full-time employment, 2 million people by 2017. One, do you believe that Obamacare does create that disincentive? And what are your thoughts on what the CBO said in that respect?
So the CBO was really reflecting a lot of the recent academic research in the field of how means-tested welfare programs affect incentives for people to remain in the workforce. But there are three major considerations as to why the ACA disincentivizes or reduces the size of the labor force. The first is the employer mandate. So by the employer mandate, by requiring businesses with more than 50 workers to offer health coverage, it increases the cost of hiring a new worker. And because it increases the cost of hiring a new worker, a lot of employers will hire less people. So that's factor number one. Factor number two is the $1 trillion in tax increases over the next 10 years that the ACA imposes on the economy, and for a lot of different reasons, just general economic growth, disincentive for people to work harder, et cetera, those tax hikes reduce economic growth and therefore contract the labor market. The third issue, which is the one that's getting the most attention, is the means-tested subsidies, the Medicaid expansion, and the exchange subsidies that, because they can substitute for earned income through wages, will give some people the incentive to either withdraw from the workforce entirely or reduce the amount of hours they work because they will be getting equivalent benefits from the government.
So that 2 million figure that CBO put out, that's only dealing with really number 3 of what you listed. They're not saying that because of the employer mandate it's going to cause that. And so in other words, if I agree with you, and I do, that employer mandate creates a disincentive for businesses that are small to expand, it creates an incentive to move people to part-time, 29 hours or less to relieve themselves of the burdens of Obamacare. If that's the case, then 2 million is already in the bank because of the general incentives in terms of means-tested welfare. Then you got to add on top of that, correct, for the employer mandate. The first 2 points that you made would be in addition to that 2 million, correct?
I believe the number for, I think it was year 2023 was 2.5 million people less in the labor force, and that encompassed all 3 factors, and they didn't break out how much was each, but I believe the third factor was the largest component.
Which I think will be interesting because I think the CBO has traditionally underestimated the impact of this employer mandate, and we may very well see soon the incentives that creates. I mean, I have businesses in my district who say, look, it's cheaper for me to pay the penalty. Now, they can't always do that because they do have some employees who would have other options who may be able to leave. But for a lot of the low-skilled, the blue-collar folks, I mean, they're going to be in a position where they're going to lose hours. They're going to be moved to potentially the Obamacare exchanges. And I think that's going to create a huge upheaval. So in terms of this deficit reduction, you had mentioned there's $1 trillion in tax increases. And I think the way they did it was there's $1 trillion in tax increases, $700 billion in Medicare cuts. Therefore, compared to $850 billion, that reduces the deficit. But now that it's $2 trillion in outlays, even those significant tax increases in Medicare cuts, that still doesn't get you to $2 trillion, does it?
This is a long subject we could spend all of your time discussing, but the CBO projections have a fair amount of uncertainty, and we can say that for sure. I think one thing that's important about this report that came out yesterday, the Budget and Economic Outlook report, is that the CBO estimated, compared to its previous year estimates, that the deficit would be $1 trillion larger, $1 trillion larger due to $1.4 trillion less in tax revenue and $400 billion less in spending. So the deficit outlook is worse than it was before, and that's largely due to lower economic growth, lower GDP growth, which potentially is in part a result of the ACA and its tax increases.
Oh, absolutely, and I thank again the chairman. And I would just note on top of that, it's my understanding that the CBO director today, when he was in front of the Budget Committee, said that they are forecasting less economic growth in large part because of these incentives.
Thank you. Mr. Roy, if you had a comment on it, you can certainly do that.
Yeah, I think that Mr. Meadows has raised an important question, which is why is it that many of the co-ops are located in states that already have relatively competitive individual and small business insurance markets? The states that have less competitive insurance markets where the co-ops are most needed are not the states, generally speaking, where the co-ops are participating. Therefore, in that essential way, they're not achieving their goal. And this gets to the point that Dr. Van Riper mentioned in her opening statement, which is she said that there was a study that showed that in the states where co-ops were participating, average premiums were lower than the states where co-ops weren't participating. Well, that's not because of co-ops. That's because those markets were already competitive, and therefore, because they were already competitive, average premiums were lower. Co-ops have no causality relationship with those results.
Right. It's too early on that. Dr. Van Riper, it looks like you want to respond to that. Then I have several questions with that as well. Did you want to respond to that?
Yeah. I mean, that's simply at odds with what the evidence shows. It shows that around, in co-ops where or states where there's co-ops, this is operating on the exchanges. It's 8 to 9% lower premiums across the board.
So, but you're saying it's cheaper last year when the co-ops were new, or cheaper this year? Because you were saying several months ago when it came out. Because when you quoted that earlier, right. I thought, how did the co-ops reduce prices last year or for this year when they're just trying to get online right now?
Right, and isn't that a good question? I think it's based on historical data, yeah.
So, but we don't have any current data on it. It's just an assumption that co-ops are in these states, prices are going down, but trying to develop the causality, we don't know yet.
We don't know, but I mean, just like with all kinds of other projections, it's based on historical information and projections by experts. Yeah.
Mr. Roy.
I just want to add one thing, which is that actually it's not true that premiums are going down in the states with co-ops. So average premiums on the individual non-group market are going up by an average of 41%, according to Manhattan Institute study across the country. Only a small handful of states are seeing decrease, and that has to do with prior regulatory schemes. Generally speaking, premium rates are not going down. Relatively speaking, on the exchanges, some states have higher premiums, some states have lower premiums. That's what this study is addressing. It's not addressing rates in the 2014 market relative to the 2013 market. In the vast majority of states, I believe 42 or 43, premiums are going up, in many cases dramatically.
Right.
I want to get your comments, if I could, Mr. Herrick, Dr. Herrick, Dr. Stark, and Mr. Roy, just on the Vermont disaster and what happened there, and just your thoughts there. I mean, I don't know if you've analyzed that particular case, but here's one that failed, lost taxpayer money, gone. Mr. Fleischer wouldn't even come answer our questions, even though he got paid pretty large amount of money for sitting on the board. So if we could, Mr. Chairman, go through, and then I'll be done for the day.
A couple of points, 3 points quickly I'll try to make. The first is that Vermont famously is attempting to install a single-payer system in their state. So in a sense, they have as much incentive as anyone to try to get government-sponsored plans in there. So it's particularly notable that the co-op was not licensed in Vermont. The Manhattan Institute study I cited earlier, which I know I've discussed with this committee previously, the average 40-year-old in Vermont will face individual market premium increases of 125% under the ACA compared to 2013 rates. So Vermont is one of the states seeing the highest premium increases in the country. And one of the points I want to make, the final point I want to make, is on this issue of how the co-ops are pricing their plans. There's been a lot of discussion in the House of Representatives about the risk corridors in the ACA and how those are a form of potentially taxpayer bailouts. And I think this is a good example of where that is most likely to be true, which is that co-ops, first of all, having no experience in pricing these products, two, having no negotiating leverage with providers and therefore having high reimbursement rates with the hospitals and doctors, are likely to underprice their products to be competitive and gain market share, even though their costs are likely to exceed the premiums that they're charging, and therefore they're going to be loss-making entities, but they're going to benefit from these risk corridors and other adjusting features in the law. They're the most likely to be reckless in the way they price their premiums and require further taxpayer support to compensate for that fact. And I think that's something that this committee could be useful in looking into.
You can't seem to answer my question directly. How in the world do you market that to a consumer? You know, if I'm going to get health care coverage, and I'm going to go to a co-op, and let's say I'm going to go to Blue Cross and Blue Shield, what's the difference in premiums in New Jersey? Do you know that figure?
I do not know off the top of my head.
So how do you market it to the consumer if you don't know? I mean, how do you know?
I am not marketing a co-op plan to the consumer.
Well, that may be the
Co-ops
problem
are.
why we're having a
Co-ops
problem with
are.
co-ops is because we're not marketing
We
it.
had a 2-hour conversation on this. I really appreciate you coming. This is the first hearing on this topic. This is a $2 billion piece of the federal budget. It is important that we get a chance to have this conversation. This conversation will advance with members of the administration as they're trying to work through the process of how they're handling the regulations on this. But the information that you all brought today, both in your written testimony and in your oral testimony, was incredibly beneficial to us to get some perspective about what's happening and how you're trying to manage it. Obviously, there's lots of numbers and lots of facts and figures still to come as this rolls out in the next couple of months, and then time will most certainly tell where this comes out. Proverbs says, wisdom is proved right by her children. And this will be one of those moments to be able to look at and say, what are the children that are born from this process and where does this go? So I'd like to thank all the witnesses for coming, taking so much time from your busy schedules to hear from us today. The committee will stand in recess until we get a chance to finish testimony of a witness that did not arrive today. Thank you.